All right, real estate in 2025 going into 2026. We're going to go heavy on what's in front of us. But first, I'm going to start with an overvalued, undervalued. Rapid fire. You ready? Short-term rentals in 2026.
Overvalued.
Build-to-rent communities.
Depending on market,
BTR, baby.
most of them I would say overvalued.
Dang. Okay, we're going to talk about that. Multifamily deals with floating debt.
Floating debt, overvalued.
Senior housing development.
Undervalued.
Your tier one cities, LA, New York.
Heavily undervalued.
Ooh, industrial warehouse.
I don't have an opinion about industrial warehouse, actually.
I kind of like it.
I feel like that boat sailed a long time ago, though, didn't it? On
Industrial-
on warehouse, industrial.
Industrial went
Like
out.
it was the hot thing 5 years ago.
It was with Airbnb. They're both flushed out.
I don't know. Are they?
I don't know. We'll see. We'll talk about that. Ground up development.
Undervalued.
Secondary markets, like my favorite, Boise, Chattanooga, OKC.
Overvalued.
Cash heavy investors who are sitting on the sidelines.
Overvalued.
All right, let's get into this. Interest rates are a big factor to commercial real estate, right? It's everything for us.
They're huge.
So, real quick, can you give high level the difference between what we do in real estate with commercial real estate and single family, and why our experience and what values have done for our assets have been completely different than SFR in maybe some of the undersupplied markets?
Well, if you break apart SFRs versus multifamily, they're just driven on completely different metrics.
What's SFR driven on?
Location, schools, crime rates, a lot of emotional factors, community that you want to be in. Multifamily is 100% economics, right? For us, it's what's the income, what are the expenses, what's my cap rate, and does the deal pencil? We care about location. Obviously, we want to be in the right markets, but our decision about being in the right markets are not qualitative, they're quantitatively driven, right? Like we went out into a market in Ohio in multifamily driven on a housing shortage and the ability to bring 800 units on in a market that had a need for 12,000 units. We are heavily focused on California based on quantitative measures. For me, looking at a home, I want to be in the community near my kid's school. I want to be in the community that people that I know. I want to be in an area that's low crime. It's not economically driven whatsoever.
So SFR cares about your feelings and multifamily cares about facts?
Sure.
I like that. As far as the Fed expectation, because everything that we were hearing 2 years ago was survive till 25. The expectation is that the Fed was going to start reducing rates at some point in 25. And we did not see that at the last meeting. We didn't see that at the meeting before. Where do you think we land right now on Fed expectations on what they're going to do with rates?
I don't think we're going to see rates go down for probably another year at least.
You don't?
Like in a material way.
Okay, we'll take material out for now. When do you think the next interest rate reduction is?
Oh, aren't they forecasting like 6 months from now?
Two
Is
meetings?
what they're saying?
Yeah, that's what they're saying. So expectation is in two
Maybe
meetings
maybe we'll see another 25 basis point drop at that point in time.
or 2 quarters.
Two quarters.
Okay, so what's interesting is I think maybe you could make the argument that before this whole Liberation Day came about, Fed might have lowered interest rates this last meeting. The tariff situation kind of, I think, really jammed up, at least for us, rates coming down, right? Because if one of their goals with combating inflation is the interest rate control or lever, if they had an expectation that inflation was going to rise, I don't think they were going to lower rates anytime soon, right?
Right.
As we're starting to see deals getting done and that tariff rate come down, at least significantly where it was, China was like a big, I think, indicator of where we're headed. I think it is reasonable to say interest rates 2 quarters from now drop.
By
right?
how much?
I think 25 bips is the call.
So the question then becomes, does 25 bips move the needle to where deals now make sense?
Well, no. Like if 25 bips makes a deal work for you or not, it's probably a bad deal. But I would probably argue that as you start seeing rates come down, maybe your forecasting changes on your underwriting. And so that might turn on the people that are more long-term in development, right? Like for us looking at a new deal today, we're not starting that deal for 3 years from now, right? So maybe your underwriting looks different. Maybe your pro forma looks a little better. I don't know. That's a good question.
Yeah, but
I think
we're still earmarking higher interest rates in the deals that we're underwriting today. I think the bigger issue is though people that were doing deals 3 years ago, 4 years ago, that were relying on sub 4% interest rates that are stuck now because their deals no longer pencil and they're just basically trying to wait this thing out.
Yeah, for them, I don't know. Like, have you been seeing a bunch of products hit the market that are distressed through the situation you just said?
No, because I think people are still bleeding cash, just trying to wait this thing out before they start unloading assets. I mean, we are seeing a lot more deal flow right now. That's for sure. Have we seen the level of deal flow that I think we're going to see? I think it's going to continue ticking up, especially as long as interest rates stay high. And remember, people are not waiting for rates to go sub 5. They're hoping that they go back to like the 3.5 to 3.75.
Yeah, they're wrong with that.
I agree.
Yeah, they're wrong with that.
But if they modeled the deal thinking that they had to be at 3.75 or call it just under 4% in order to do the deal, which a lot of people did and took out a huge amount of leverage in order to make that happen, they're in a bad spot.
Okay, so considering you're not in survival mode with a deal that is distressed, right? Let's talk about new deals moving forward. How significant is a 25 BIP reduction? Also considering that cap rates have like significantly softened, right? Like where were cap rates in 21 for like a Class A apartment in LA? Sub 4?
Sub 3.5 in some cases.
Okay, so if you're let's just call it 4 to be generous. Now they're trading at like a 5.2 cap, 5.5 cap.
It's massive.
Bro, that's massive. That's more than the financial crisis.
Well, here, let's do.
You want to do some math?
I mean, let's just to draw the example, right? If you're talking about,
Let's say I have a project generating $2 million of NOI at a 4 cap. What am I valued at?
$2 million at a 4 cap is a $50 million valuation.
Okay, so how much money did I lose in value if it's now a 5.5 cap?
$2 million at a 5.5%, $36.3 million.
So I've lost $14 million in the cap rate moving, unrealized loss in the cap rate moving that much.
By 125 basis points.
Okay, so then let me ask you this. If things are trading at a 5.2 cap, where do you think interest rates need to land for stabilize and maybe some of the light value add strategy to work again?
For it to work, like to just wait it out, or for you to actually make money?
Good question.
If you need it to wait out, you need them to be almost at parity with each other.
At what point do we start seeing that strategy come back into play for new dollars?
200 basis point margin between financing rates and cap rates.
Okay, so then does that mean that cap rates have to climb higher if interest rates are not going to go sub 5?
They do. Yeah, so if you're borrowing at 5.5, you probably want an asset that's trading at a 7.5 cap rate if you want to make some money on it.
Okay, so then walk me through that. If brand new product was trading at a 4 cap, like you're like Freddie Fannie, you weren't getting a 2% loan. How was that working?
Well, you're talking about back in the lower interest rate days?
Uh-huh.
Well, you were borrowing closer to like 3.25%, 3.5%, and you were trading at a 4%. That's what you're saying? How did those deals work?
Yeah.
Those deals weren't necessarily trading actively. Those deals were a lot of buy and hold positions.
So they were just letting rent grow.
Yeah.
And that's how they're capturing their spread. How significant is baby boomers moving out of single family homes and into senior living? Do you think that we are going to see baby boomers at scale need to move out of their single family? And if so, do we have the supply to handle that?
I don't think we have the supply in the assisted living space in order to offset the increased baby boomer relocation. I think it's a great asset class, but it is very complex.
For the seat, because it's not some. We have one apartment where you have to be 55 and older to be in.
Correct.
But then there's also assisted living.
Right. I'm
Right.
talking more on the assisted living side.
On the assisted living side.
Yeah, I mean, there's there's nursing facilities, assisted living facilities. There's a lot of compliance that goes into those. So it's not just building housing. It's a very unique level of asset class. But I think the demand is pretty significant there.
So do you think we're going to experience what we are seeing right now, which is astronomical rents and pricing? Will we also see that in the assisted living space if there are too many baby boomers coming in and not enough supply for them?
Yeah, I mean, again, the economics don't change. If you have a huge demand and not enough supply to offset that demand, prices are going to go up. If you have way more units and not enough demand, everybody's competing for that smaller population of people. So people are going to compete on pricing. Prices are going to come down. It doesn't change depending on what you're talking about.
Maybe this is going back into your old.
You love tapping into my old financial advisor days.
Yeah, I'm going to ask you a financial advisor question. Did you have any clients that worked with you whose parents were going through the like elderly stage and potentially into assisted living? And did you have to work on financial planning for, let's say, a millennial on how they're going to help their parents? Like, what is that scenario like from an investment standpoint if your parents are not financially free or set up for that? Is it the kids taking that on, and how do you plan for that?
Yeah, it's actually, interestingly enough, it's very culturally driven. So depending on the culture, some cultures will take the parents into their home. Other cultures will tell their parents, go to an assisted living care center.
You guys do that.
We generally have parents move in. The Middle Eastern culture is very much oriented that way. I'm not saying one is better than the other, just every culture treats it differently.
Yeah. You know what's funny, Jen, my wife's been talking about this a lot, that was kind of the old school way to do it, but there are a lot of elements that are nice about that. Like when you have grandma or grandpa coming in, there's a lot more support you get with the kids that is kind of nice. It's almost like a all hands on deck scenario.
Yeah, it's definitely easier for the parents in one way, but in the other way, the parents are also now responsible for taking care of elderly parents.
Yeah, if you have
elderly grandparents.
Yeah, and if you have a tough one.
Yeah.
Like if you have like an insane mother-in-law.
Yeah, so on that note, the assisted living center or elderly care facility, that plays into hands, and some people are financing it. I mean, listen, Medicare and Medicaid kind of steps in, but you're not getting a good quality facility for that cost. And so, a lot of kids are having to come out of pocket, and it's expensive.
Yeah.
Which is why long-term care plans were so in probably like 10 to 20 years ago.
Right. Hey, so what we're starting to see, finally, developers coming into areas that are undersupplied and build. Right. I've been talking about Austin because we had a rent reduction of 22%, so significant. I was in Phoenix, saw the same thing. So you're starting to see developers build in undersupplied markets. Isn't that what they're supposed to do? And is it bad now that there's a crash happening?
I don't think it's necessarily bad. I mean, I think the market is going to do what the market does.
Okay, so if you're an investor and you got in late, right? You were one of the investors that we were
Texas
talking
markets?
to, and we're like, I'm not going into Ventura, I'm going into Texas, right? And now there's a 22% reduction in your target rents. Is that a good day for you or a bad day?
No, it's a terrible day for you. I mean, you went in thinking that you were going to capture these rents, and all of a sudden 22% hit to your gross income. That's huge.
Huge.
Yeah, it's huge. Not to mention your gross income's going to go down. Your expenses are arguably, many of them are fixed. And so you're not going to have like a relative drop in your expenses. And so your bottom line is going to reduce almost in parallel to that 22% reduction on the gross revenues.
Okay, and you could probably argue that if you're seeing a 22% rent reduction, you're probably also seeing a softening in cap rates. Mm-hmm. So now
remember, cap rates are indicative of not just your income level, but they're indicative of risk also. Higher cap rate markets or markets where cap rates are going to soften are usually, you see those in secondary or tertiary markets.
Right.
primary markets generally have lower cap rates.
Right.
So cap rates is also an indication of risk as well.
Right. So if you were an investor who decided to invest in Austin, Texas, thinking it was the boom, but you were late and experienced 50,000 new units come online, and now you've watched your investment get wiped out, or maybe, what you were expecting to make was a 15% IRR, now it's 4, what do?
You hold on to the asset.
Hold on to the asset.
I mean, unless you want to sell and take the L. I mean, remember, the L doesn't happen unless you sell.
Yeah, I like that.
You're
That's
down, you're just not out.
Okay, so what advice do you have for them on the next deal they do after having that experience?
I would understand what the drivers are in the market that are compelling you to want to invest or not. If everybody's talking about Idaho, we'll use Idaho. I feel like we bash on Idaho a lot.
I know. I've got some, maybe there's something I got to work out there.
If everybody's talking about Idaho, you have to invest. I would proceed with caution. And I generally have this rule of thumb whenever I start hearing everybody talking about it. So I felt like everybody was talking about Texas. Everybody was talking about the Carolinas. Everybody was talking about Tennessee. And I think now we're starting to hear like those markets are now saturated and people are not generating the kinds of returns that they maybe did, or now they're starting to look at diversifying away from those markets.
Okay, so how do you, like, you and I are a little bit different because our entire business is investing. We rely on a lot of data and market studies, and we have a lot of information prior to making an investment move. For somebody who doesn't have that, what do they do to avoid that scenario? Like, is there a point where, like, how many people do you have to hear about investing in, let's say, a market like Texas for you to go, that might be oversaturated? Like, how do they find a good market to invest in if they don't have the resources that we have?
So I would look at, there's a lot of public resources out there that can give you indications of what markets are more favorable and less favorable. I like to look at shortages, housing shortages, right? What's causing the shortage? Is it bureaucratic issues at the government level? Is it, employers that have been leaving it, or employers that have been coming in and not enough housing to support it? So what's driving a supply and demand imbalance? Because that to me is at the crux of the issue. One of the biggest things that you can look at. How many people need to live there? How many units are available? And what's the gap between the two? I tend to like primary markets more than the secondary or the tertiary markets as a whole.
So you want smaller cap rates and less cash flow?
Less cap rates, less cash flow, but longer term potential for appreciation.
And a little bit less risk.
I mean, it's a de-risked investment for me. But one of the crazy things about California is you are going into a market that is heavily supply constrained and benefiting from cash flow because it's charging higher rents, but then getting the lower cap rate where you can benefit from the capital appreciation long term. So it's kind of unique in that sense, right? Where you're able to tackle all three of those. I would look at that. I would look at, employment. How many employers have come into the market? So what's the current supply and demand issue? Current supply and demand balance in the market. What's employment looking like? I would look at net migration. So if you're looking at a specific city, how many people are coming into that city on a given day versus leaving it? And some of this info, we have easy access to it, but it's accessible by the public. And I would probably just use AI to help find the sources for it.
Yeah, it's actually, as you were saying that, a lot of counties will do like a state of the county, and they'll do it annually. And you'll get a lot of information, especially what you just mentioned, for the cities inside of that county. They'll talk about, what the net migration is. They'll talk about the employment. They'll talk about, where rents are, median income, household income, value of your home, or how expensive a starter home is. You do get a lot of information. You can kind of gauge the pulse of what's happening. And then a lot of cities, you can go in, it's all public information. So you can see what projects are on the docket, what projects have recently been entitled, to give you an idea of what's to come, to make sure that, if you are making an investment, you can actually hit those targeted rents, right?
Well, and also the cities, you could look at what are they focused on? Are they trying to build more commercial? Or did they adopt a general plan to implement, a ton of housing units? Because that will tell you what the need is based on what the constituents are telling their city council members. And then what in turn the city council is doing to try to solve those issues. That is a huge indicator of where their focus is and what you should be going after. Also, because if they have a general plan for housing, you don't want to necessarily go into that market trying to build storage, let's say, because that's not where the city's focus is. You're going to be slow tracked on the entitlement process, slow tracked on permits and working drawings. They want housing. Your storage property is going on the back burner.
Okay, so you're correct. Now, I did want to talk about this at some point, like what the 2026 opportunities are. This might be a little bit further out than that, but I think there is a case to be made. And I want your opinion on this. If all these cities are retagging land to be mixed use and multifamily, and a lot of them are basically outzoning storage, can't do new storage, should you be buying existing storage now, knowing that the city is going to be increasing the amount of bodies in that area because everything's just been tagged multifamily? And will we see a scenario in storage like we're experiencing right now of a housing crisis and rents flying up and then values, going through the roof as well?
So you're saying supply for storage remains flat.
Right now, storage is saturated. So you can get storage at a discount. Will you see rents start growing faster than they should because more people are coming into a city because they're retagging everything multifamily, adding new units? You're not allowed to do more storage. Are you now going to get in a supply-demand deficiency or supply below demand? And are you going to be in a field day the way we've been in housing?
Correct. And again, it goes back to the basic economics. Your supply is 100 and your demand is 50, right? You're oversupplied. You're oversaturated, which is the case today. They implemented general housing plan to add on 200 units. Well, now all of a sudden you're up to 250 and you're still at 100 on storage. Well, now you have greater demand than you have supply, opportunity to raise rents. It may seem like it's an oversimplification to just look at basic supply and demand equations, but at the end of the day, that's what drives economics. Supply, how much is available, and how big is the demand for whatever it is that's available.
Okay, so why are all these people getting it wrong right now? Like, why do investors have such a hard time? Not institutional investors, right? They know what's going on. For your average retail investor, do you think they overcomplicate things or investments that they're looking at? Why isn't it? Are we oversimplifying? Like, why do so many investors miss the moment?
Because it's really uncomfortable to be contrarian in thought.
It's uncomfortable.
Right? It's a lot easier to go with the flock than it is to go against it. I mean, it is as simple as that. Like, you keep hearing everybody doing Texas, South Carolina, North Carolina. It's like, oh yeah, I'm going to do that too. I'm going to run with the herd. All of a sudden, you tell those people, no, you keep going. I'm going here in California. They think you're crazy. And that's a hard hurdle for a lot of people to overcome.
So it's a psychological scenario. It feels good being surrounded by people, and you're investing based on the feeling, but going against the grain is uncomfortable. Most people don't want to be there, but that's where the real opportunity is.
That's the emotional side of it. The mathematical side of it is you can arguably get cash flow sooner in some of these other states because you can bring project online faster. Whereas in California, it's going to take you longer to get to that cash flow positive position.
You're going to take me there?
But
this is where we're going to go?
Sure. But if you look at total return, so it depends on what's important to you.
Okay. This is a big topic of conversation as of late between you and I.
Cash flow or appreciation?
Which
one's better?
Which one? Yeah. Okay. So I'm going to use this moment. We're going to do something a little bit different here. I am going to ask for your help. I want to know your opinion on this one because this is something that we are constantly talking about in our business, and we're trying to figure out what the best way to do this is for investors, right? We're of the philosophy that we want to build our wealth, and so we want a higher return. If you're looking at a 5-year hold, one is a cash flow play, one is appreciation play, and we can make twice as much on the appreciation play, that's what we're doing because we're in wealth build mode. There's other investors that don't look at it that way. They'd rather have less money when it's all said and done, but they want the money coming in instantly, right? What do you guys think of that? Like, where do you want to be, and how should you handle the financial component of this and the psychological component of it? Because, for example, for our company, and to bring you guys really specific in what we do, we build. So just from the point of an investor coming in and building, considering you're through your entitlements and permits, that's 2 years. Lease up on the size of projects we do, we're typically getting it stabilized in that third year, right? Then distributions come, then a potential cash out refi comes, which is typically big, right? But investors don't see a cash return for 2 years. Now, for me, I've always been okay with that because of what I can get back or potentially get back on the refi. And then when I'm looking at the cash flow based on what I still have in the deal, it's psycho, right? It's phenomenal cash flow. But then other investors go, I'm not waiting 2 years. Are you crazy? Or even something that we, are constantly mindful of. For us, if we have investors that come in when we're trying to entitle something, dude, now you're talking about sometimes 4 years before a distribution comes into play. And the challenge you have is sometimes for certain investors, it will feel like it's not working because a distribution hasn't turned on. But in reality, it's going exactly according to plan. Now, that might be something that we need to do better on the communication side, or maybe it doesn't matter how much you communicate until you get money in somebody's pocket, it still feels like it's not. So I want to know your guys' opinion on that. What do you guys want to see? And if you have an idea for people that are in wealth build mode like us, how do you get cash in somebody's hands faster? Maybe that's not even an option. Thoughts?
Okay. Well, let's first decipher the difference between people that want cash flow versus appreciation, where it makes sense. Younger family, younger couple, working, making money to cover their expenses, appreciation all the way is generally what they're thinking. Older person who's getting close to retirement or may already be retired is now looking to supplement the income from the job that they used to have. So that's where the decision of one over the other actually makes sense, right? If you are older, you want cash flow. If you're younger, you really should be looking at appreciation. What we're dealing with, though, are people that are younger, that are making good money, that think that they need this supplemental income just because it feels good to get a check in the mail. And what they're missing out on is more wealth appreciation long term, so that when they get to that later stage in life, they're drawing from a significantly larger pool of money than they would otherwise be drawing from. So the more cash flow you're taking up front, the less appreciation you're getting on the back end, and vice versa. The more you're delaying that gratification, the more I said that the wrong way. If you get cash flow now, you're giving up appreciation. If you forego cash flow, you're getting a lot more appreciation on the back end. So which one is it that you want? What I don't understand are the people that are psychologically driven to think that if they don't see a check in the mail starting on day one, they don't think it's working. It makes all the sense in the world. You're doing a build out. It's going to take you 2 years, let's say, to build this project. Where do you think cash flow is coming from if there's no project that's generating revenue, right? It's going to be delayed as a result of it. But on the back end, once you build the thing out, it's worth so much more than where you started. That cash out refi gets you 70, 80, 90% of your money back in year 3. And now your, let's say, $100,000 investment, your net investment in that deal is $10,000.
Yeah, you got like 20% cash on cash return.
And you're getting paid maybe $2,500 a month. You're making a 25% cash on cash yield.
Based on what's still in the deal.
Right. Yeah. And you got your 90 grand back to go do the next deal. And so I'm always troubled with the people that are younger, that don't need the cash flow, that are very fixated on it. And it's always been a struggle.
Yeah, I think it's probably how we started off the conversation. If you feel like you're making the right move because you're looking around and everyone else is doing it, it's a comforting place to be. It's not where the opportunity is. this is probably just one of those scenarios. Like everything you say is right. It just goes against the feeling.
In the conventional thought.
Yeah, I don't even know if it's a conventional thought. I think it's a feeling thing. Like when money goes in your pocket, it feels like it's working. You know, that's just, I get it. Like you're right. Like where's the money coming from if you haven't built the apartment? But I do agree. Like if money's going in your pocket, it does feel better.
Well, and let's not mention there's a tax issue too, right? If you're younger and you're making good money, getting cash flow is only increasing your tax basis, right? And so you want to also play the tax game a little bit because the greatest cash flow opportunity in many scenarios is in the private space is private lending, right? You have no asset that you own. You're simply a tool for a debt instrument. You're getting no depreciation benefit on an asset. You're getting taxable income. And so you're only increasing your tax basis as a result. Whereas when you do the equity side of the deal, you may be delaying income a little bit, but you're going to capture significant K1 losses as a result of the investment. And generally speaking, when you get the refi proceeds, that's non-taxable income.
Yeah, I think it's a feeling of risk. Like I did the poll last week. What would you choose? $100,000 investment, 5-year hold on both. One pays you 8% that starts immediately. The other one doesn't pay you until year 3, but the net result is a 2x multiple. So $100,000 investment on both. The 8% cash flow gets you $140K once it's all said and done. The other one gets you $200. So you can make an extra $60K on the secondary example. If you're comparing debt versus equity, yeah, there's a tax component to this that we didn't even talk about. 40+% chose the 8, right? And my audience is not retired, right? Of course I have some audience that is, but if you look at the bulk of my audience, it's 20 to 45, right? This is like wealth build mode. And 40-something% mentioned they would do the 8% immediately. And a lot of them said it's because of the environment. Like at this time, with this uncertainty, I'm taking the 8%.
Why is the 8% instrument more certain than the equity instrument?
Well, I think it's the delay of cash flow, right? So like what I heard a lot of people say is, I'm getting money immediately. So if I'm starting to get money back, I'm actually realizing something instead of the promise or maybe the lack of promise. Instead of the idea that I may get something on the back end, but I may get nothing. So it's less risky if I'm getting some of my money back as opposed to banking on the whole thing coming at the middle of the deal.
So if you invested $100,000 and let's say you were able to get a 8% coupon rate, and compared to $100,000 on an equity play that had 2 years before the refinance, that $16,000 that you're getting in cash flow for the first 2 years gives you that much more confidence in the security of that investment over the equity play?
Not me.
That's what I'm saying. That's what the poll. And so I look at that and I say, I feel like that is a security blanket because of a more of a psychological, limitation that they can't see past the risk. And again, if you are on the older side and you're getting closer to retirement, cash flow makes sense all day long as far as I'm concerned at the forefront. If you're younger and you're making good money, why are you taking the cash flow? The metrics of the deal, like I could do a cash flow deal that let's say is a loan, just for argument's sake, and it's an 8% coupon rate. And the property that we're lending against or collateralizing the loan is worth $1 million. And the PE firm that did it is doing a $950,000 loan against that $1 million asset. That is a very high risk investment. Okay, it's paying me 8%, but what is the underlying investment and how is it structured? On the equity side, if you're doing a delayed cash flow because it's an appreciation play, but it's structured 60-40, well, that's a lower risk investment if I were to compare the two. So I don't think looking at it through the lens of just cash flow versus appreciation is indicative of risk. You got to go past that and look at the actual investment itself.
Yeah, I think you're right. All right, moving on to upside 2026. What's on the horizon? The 5 opportunities that could explode next year, right?
Okay.
Number one, build to rent communities. Number two, senior housing. Number three, adaptive reuse from retail into mixed use or multifamily. Industrial micro warehousing in urban cores, or distressed multifamily that we talked about earlier with debt coming due and they can't refinance. Starting on the first one, right? Build to rent communities. You're seeing what looks like a suburban build of, let's call it 500 houses, not for sale, all for rent. You think that's a hot opportunity moving forward?
I don't like such large projects.
You don't? Why?
It's too big.
What do you mean it's too big?
I don't like anything over 100 units. First of all, I feel like we're competing with the wrong people in doing that. But if you're going to invest passively with, the big institutions that are doing it, maybe. It's just not for me. And it's very market specific. In your secondary, tertiary markets, maybe the build to rent would work. In markets like Austin that are already oversaturated, I would not touch that with a build to rent.
Okay, let's address the first thing.
Okay.
The size of it. So if it was 100 units, you'd be okay with it, but 300, you're scared?
I would feel more comfortable with, sub 100 developments than, 100 plus.
Is this a limiting belief? What is this?
No, it's a supply and demand thing, right? Like the more units you bring online, the more exposure you have to ensure that you have enough tenants that are going to come in. If I put on an 800 unit development, I need to have a massive amount of demand in order to offset that increase.
Okay,
supply.
so what if that demand exists? What if you're short 50,000 units and you're going to put 300? That's a drop in the...
So again, it goes back to other factors beyond just 500 units in a market.
Okay, so-
what's in the docket?
Okay,
to be approved?
let's clarify this. Let's
give me a better scenario.
You have found a market that's undersupplied. And now you have some options. Build a multifamily apartment, a BTR community, or build single family to sell. And you're like, oh, maybe I'll look at build to rent. You still don't like build to rent?
Dense population,
Undersupplied.
undersupplied market. I'd probably still go multifamily.
Why? Interesting.
I don't know. It's what I'm comfortable with too. I mean, like
This is a feeling? This is
yeah,
not
it's
a fact?
total
This is a
feeling.
feeling?
I mean, it's what I'm comfortable with. I am very comfortable in the asset class that I know well. The build to rent communities, again, there's something about building hundreds of units that. Here's a good example. When we were underwriting Ohio,
Okay.
do you remember that? That was an 800 unit development.
I do.
We looked at that and said, there's a market for this 800 unit development. There's a need for all of these units and arguably even more than that. When we underwrote it, though, we also said, if any variable here goes wrong, the shift in how much added capital is needed is so big, it could cause the deal to fall apart. There is a issue when you do massive developments over, hundreds and hundreds of units, that a small deviation in, construction taking longer, lease up taking longer, financing rates or cap rates moving on you, the impact on the economics is amplified significantly the larger your development is.
Well, is it, or isn't it all...
It's all relative.
It's all relative.
Yeah, it's all relative.
So considering, like for us, if we're looking at Ohio, the main reason was we were not at the size or level to... We could not save the project because we didn't have the capital to do it if something went wrong. If we did have the capital, aren't the same factors at play whether we're building an 88 unit at the beach or a 800 unit in Ohio? Considering you have the capital?
I would rather do 10 80 units than one 800 unit. Which would you pick though?
Well, now I'm a little scared that soon you're going to start telling me you want cash flow. What is this?
No,
What is this?
very different.
This is feelings.
No, would you go with a single 800 unit project?
If I could pull it off, 100%.
All right, man, teach you.
100%.
I'd rather diversify and have more assets than I would a single asset with so many units.
Okay, fair. So BTR over BTR.
In certain markets, I don't think it works. In other markets, I still think the market hasn't gotten saturated enough to where it probably does work.
Okay, so Michael is cold on BTR.
Cold.
For me personally, I like it. I think it's sick. I'm not building a portfolio around that, so maybe use that as a, I don't know what you want to call that. What would I even say? Statement. But I think BTR is rad. What we do have a lot of experience in, adaptive reuse. Now, we convert retail into storage. What about retail into multifamily or office into multifamily? An adaptive reuse play into residential. Is that a hot opportunity for 26?
Okay, so let's establish first why adaptive reuse works for storage. Because we are taking a retail space, we are gutting the entire interior, and we're putting up storage units. That's a very low cost proposition. The issue with office is the cost of converting office space into housing is very expensive because you need all the bathrooms, you need all the kitchens, you have to completely redo your water and electrical infrastructure. And so at least the deals, because we have looked at some of them, the deals that we've looked at, the cost is so prohibitive to actually get there that it kills the deal. I've heard of some people that have figured out a way to make it pencil. Personally, we may be looking at it too conservatively. I haven't seen one that actually worked. So the office to housing, I'm not a fan of. The retail to housing, that has some potential because generally speaking, your retail locations are in high traffic flow, highly walkable areas.
Would it be adaptive reuse or would it be redevelopment at that point?
It depends.
Like keep the existing retail and just build on top of it? Could you even do that?
You could in certain scenarios. I mean, you could do whatever the city will allow you to do, but sometimes the foundation won't support so much weight, and so you may have to kind of redo the foundation. So I think it just depends, but I'm much more comfortable in retail to multifamily or mixed use conversion than I would be office to multifamily.
Okay, so far we're 2 out of this 5 is trash for you.
I wouldn't do office. Retail I'd be open to though.
Okay, I like that. Senior housing, this is going to be an easy one. Is this a great opportunity for 26 or is 26 too soon?
No, I think it's a good opportunity to go into it. Again, I say this as somebody who doesn't underwrite senior housing or, elderly care facilities. But let's just say I know a lot of people that are very wealthy in this space.
That's fair. Okay. Industrial micro warehousing.
I like the concept a lot because the ability to have a facility that houses product in order to get it to the consumer faster. So, call it your 5, 10, 20,000 square foot industrial site that can get things to the consumer quicker. I like that concept.
So this is like same day deliveries. This is like your e-com heads. This could be huge for them. I guess my question to you is, does Amazon eventually crush that? Or do you think there's always a place for the little guy to compete?
I think the little guy doesn't build it to keep it. I think the little guy builds it to sell it.
What do you mean by that?
I think the little guy builds it, gets it ready, has it perform, and then they'll end up exiting to like an Amazon or a fulfillment center of a larger brand.
Okay, so you like this one.
Yeah.
Okay, so now we're 50-50 on this list. 50% a go, 50% trash.
I like it.
Okay, last one.
I like it because it makes sense if you think about it. Like these warehouses that are really far away, how much more efficient do they become when they're closer to the proximity of their residents?
Yeah, the same day
delivering
stuff
to.
is getting good, right? What's going to happen to your in-person? We've got some room to go. Okay, distressed multifamily. We talked about a lot of projects are distressed. A lot of projects need capital, but we're not seeing a lot hit the market. Is there an opportunity to grab these things up? Is there an opportunity for pref equity? Is there an opportunity there?
Yes, on both. I think there's a strong opportunity for pref equity. So builders and developers that have misaligned the cap stack on their projects are going to need an injection of money. And when they go out to people that they need the money from, you have the ability to go beyond the common shareholder. So remember, the cap stack is always going to be debt gets paid first, then your preferred shareholder, then your common shareholder. If you can come in above the common shareholder into the pref, you're in a more favorable position. Can't always do that, but when the developer's in a pinch and they need the money in order to survive, now you can negotiate for a more favorable position on the pref equity side.
So are you saying that you can be in a better position in the capital stack and make a higher return in that safer position?
Correct. Because you're going to get paid after the debt, but before the common shareholders that came in earlier than you
Yeah,
did.
that's a good spot to be in.
That's a really good spot to be in.
Okay, so I was thinking we would go 5 opportunities to go after in 26, 3 to avoid. You just gave me 2 to avoid, but we're going to just add on to it. The opportunities to avoid in 2026. Okay? You already know. What's that? Before I even say it, what's the first one?
I don't know. I
Just
don't know.
guess.
I don't know what you're thinking.
Just guess.
Airbnbs.
That's first. That's first, bro. Avoid short-term rentals in these overcrowded markets. I'm also going to maybe make the claim that their whole situation is getting disrupted right now.
I agree.
The experience for the client that uses Airbnb is kind of trash right now.
100%.
So number one, and Avery, this isn't a shot at you. You are so awesome, and you have a unique approach to it. But for the masses, we're saying avoid short-term rentals in 26.
Do you think the issue is the short-term rental or the person that's running the short-term rental, though? That they're just
I think it's both.
too cost-minded, and they don't understand that the experience of a short-term rental is elevated above and beyond that of a multifamily project.
The thing that I'm scared of with Airbnb for Airbnb investors is there's multiple factors coming at you at one time, right? You have operators that bought in 21 and 22 that honestly just shouldn't have. They're not real estate investors. More specifically, they're not hospitality operators. The second component is the political risk. There's a lot of political headwind coming to a lot of markets that makes it challenging. Airbnb as a whole, like the platform and the fees and how expensive it is, it's not competitive anymore. And then a lot of markets are moving out of undersupplied and into saturated. So you've got 4 factors coming at you all at the same time for a lot of Airbnb operators. That has the potential of it being a death blow.
I think the biggest of those is that people underestimate the effort that it takes to actually operate that business.
Yeah, that's probably right. Yeah, so look, it's a good way to say this. For those that are like doing Airbnb like you and I do multifamily or storage, this is your business, you're professionals at it. I'm not talking to you. You guys are fine. It's like the one-offs. That's who I'm concerned about. Like I own 1 property. I own 2 properties. That's what I'm concerned about.
I remember in 21, we had a number of investors that didn't want to come in on our projects with us because they were doing the Airbnb, who fast forward to like 23 and even last year,
they became
called
investors.
us up and like, I can't do this anymore. I just sold and I'm ready to write you guys a check.
That's right. Okay, so then can I say that Class C office conversions to residential is a no-go for 26?
Yep.
Don't do it.
I wouldn't.
Number 3, value add multifamily. Stay away from it in 26?
Deals are very limited in those that will pencil because of the high interest rate environment. There's not enough of a value add to offset the interest expense.
So you're on ice right now.
I am.
So what do you think these strategies that work for 2026 are? Development, considering that your yield on cost is, what do you want to call it, 200 basis points beyond the interest rate, right? Stabilized product with no debt, all cash?
Yeah, just know that your cap rate is basically going to be your return.
Yeah, so
the
you're
investment.
picking off 6%, 5%,
Yep.
right? Any other ways to do it?
I don't think so. Not in today's market.
Okay, so investor playbook, how to spot these opportunities early, right? We just gave you senior living. We just gave you retail conversion. We just gave you distressed assets where you can come in as pref, or maybe you're able to just buy the thing at a steep discount. Now what? Now what do investors do? Do they start learning about it? Do they find groups to invest in? What is the next step for investors to participate in what we think the opportunity is?
Yeah, it's a good question. So I think if you're an investor, you have to find what it is that you want to invest in. So what is the asset class that I connect with or that I think that would be favorable investment for me to be in. If I don't know anything about industrial, I don't have my own business in industrial, I don't get industrial, stay away from it. If I understand multifamily, if I'm of the position to say, I always think people are going to need housing and that's why I like multifamily, go down that path, right? Like pursue that rabbit hole. The next thing I would do is establish, what is it that you want? Do you want the cash flow? Do you want the appreciation? If so, that's going to dictate which investments you're looking for, right? And then the next thing I would go after is educating yourself on either the market that you're going to do it yourself in, or especially if it's your first deal, I would be looking at the groups that will invest on your behalf but educate you along the way, so that you're getting quarterly updates and annual reports and market research, so that if it's something that you want to do beyond just one single deal at a given moment, you're not just going to invest with the group, but you're going to learn along the way so that eventually you can do your own thing, or maybe you decide not to do your own thing, but at least you'll know more.
All right, I'm going to hit you with a little bit of a lightning round. I want to buy, sell, or hold.
Okay.
Right? Condos.
Sell.
Farmland.
Hold.
Storage units.
Hold.
Fix and flips. That's kind of a...
Fix and flips, I probably would be doing right now.
Mobile home parks.
I don't know. What's to do with mobile? Sure, buy.
Just buy. I have no clue.
I don't know, just like
Just
everybody
buy 'em.
loves mobile home parks, so just buy.
Hotels.
Buy.
I think hotels are sick.
Yeah.
Data centers.
Buy.
Buy. All right, everybody, you heard it here. This is one thing I'm going to start asking. We get a lot more people that watch the video than hit a heart. Can you guys hit the heart? Can we get this algorithm sending our content out? If you're not subscribed, please subscribe. And if you ever hear anything and you're interested in investing and you want to reach out and see what we're doing, I'm going to include the link in the description for you to get information for us. I would love to see if that fits. I'll see you guys on the next one.